So here's a net cash company with stable 2020 growth. My name is Andrew Stotz, and I want to welcome you to Uncovered Asia, where I explore interesting stocks in Asia that few institutions and analysts cover. The company today is POSCO ICT. And remember, this is not a recommendation. This is an exploration. So, POSCO ICT is a Korean IT and systems engineering company. It's listed on the South Korean exchange, and it maintains IT systems for its parent company, POSCO Group. It builds and operates IT infrastructure for airports, energy, construction, and steel sector. It's got subsidiaries in China, Indonesia, Vietnam, and Brazil. Now, there's three parts to this company. First is the smart IT systems, which IT systems that sense and track causes of failures. The other one is smart engineering, where they provide unmanned technologies for continuous production. Think intelligent cranes run by algorithms. And then engineering smart factories. These are solutions that automate repetitive tasks in warehouses, material transport, and power management. The company also has a social overhead capital business, which provides IT operating systems for something called SkyCube, which is Korea's first personal transit system, not controlled by human involvement, which it was completed in 2014. So there's three main sectors you can see. The smart IT is 39%, EIC is 31%, and SOC is 19%. The remainder is what's called non-captive businesses. So recently, the stock price has gone up by about 40% in the last 3 months. There's been a jump in the stock, so I've been looking at it recently. And first, let's look at the company on my FVMR scorecard. This considers a stock's investment attractiveness relative to stocks in that country or region. Attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. And I consider a company over 5 years. PTM, past 12 months, is a rolling average of the latest quarterly results. Scale is 1, meaning best, 10, worst. You can learn more about that by clicking the link in the video description down below. Now, here we can see the scorecard. First of all, fundamentals are best. Number 1, very strong. And that's driven by high margins and a strong ROE. You can also see that the asset turnover ratio has been growing. It's now up to 160 in the past 12 months. That's a pretty good improvement over time. Now, on the valuation, it's expensive. The stock is trading on about 26 times for past 12 months. Of course, we know that earnings have fallen a bit, and that causes the problem of PE going much higher. But we can also see that price to book also has gone relatively higher. We can see a 2.6 times price to book. But you can also argue that that's been that way for a long time, except for that 1.6 that happened in 2019. Now, momentum, well, high EPS growth, high revenue growth, strong revenue growth at about 8% in the past 12 months, which is very good considering the pain and suffering most companies are going through. And remember that I'm comparing this company against 770 non-financial companies in Korea. Now, if we look at risk, it's ranked in the middle of the road, but the reality is that that's being driven by the beta, which is relatively high at 1.7. The company is actually net cash, as we see the net debt to equity is a negative 33.7, and the times interest earned is just out of the park at 200 because the interest expenses are tiny. Now let's look at the company's world-class benchmarking scorecard. It helps identify the competitive position relative to global peers, and also it's a combined composite rank of profitability and growth. I call it profitable growth. And I consider, again, 5 years with PTM being the past 12 months. Scale is on 1, meaning best, 10, worst. You can also learn more about world-class benchmarking in the link below. So here we can see the profitable growth score is above average at 4 compared to 680 large infotech companies worldwide. In fact, 2019 was very good at 2. There's been some weakness in the past 12 months, meaning the latest quarters. Of course, 2018 was terrible at a 10, but the years prior was above average. So generally, I'd say this company has done pretty well. We'd have to look into 2018 to go into more detail, do some more research about what happened in that year. Now here, if we want to understand what is driving the profitable growth score, we can see that the growth ranking is world class at number 1 and number 2. And that means that either EPS growth is rising or the margin is improving. Now, profitability is not bad. It's ranked at a 4, which means the net profit margin is relatively strong compared to global peers. So what's happening at the company? Well, they've recently secured a project with Korea Glass Industrial, and that's Korea's leading glass maker, to build a smart manufacturing system at their Gunsan plant by January 2021. And in July, the company partnered with Cisco to launch security solutions for smart factories at major industrial sites and power plants. The aim is to prevent any external intrusions that could paralyze the continuous process. So, you now have some tools for understanding this company. Let me know if you have any comments in the comments below.